Hi everyone. Infosys is currently trading at a massive 33.7% discount to its 52-week high of 1728 rupees per share. At the current market price of 1146 as of May 18, 2026, the vital question for investors is whether this stock is fairly valued, given current market conditions and the perceived threat of AI disruption. Today I'm initiating a coverage on Infosys Limited with a buy rating and a 12-month target price of 1340 per share, representing a high conviction 17.2% upside from here. My thesis is built on a single insight that the market is currently mispricing AI fear as a permanent structural decline. While the consensus treats AI as a demand destroyer, I see it as a margin expander. Over the next few minutes, I am going to prove three things. First, that Infosys's 58% fixed price mix provides a structural hedge that the market is ignoring. Second, the management's Project Maximus is already reconfiguring the cost base for AI era. And finally, that working backwards from the current price reveals a fair gap of 120 basis points in the weighted average cost of capital, a mispricing that I believe will close as these fundamentals become clear. The central debate surrounding the Indian IT sector is the impact of AI. The market narrative treats AI as pure demand destroyer, assuming that productivity gains will inevitably reduce billable hours and collapse the traditional labor arbitrage model. However, my variant view argues that AI is simultaneously a critical margin expander through Project Maximus and a revenue enabler through Infosys Topaz. The net outcome depends entirely on the mix of contracts, as I will demonstrate. Infosys's structural shift towards outcome-based pricing, where they are paid for result rather than the hours, allows them to retain these efficiency gains as margin expansion rather than passing them to clients as cost savings. We are witnessing a historical decoupling of revenue and labor at Infosys. For decades, the model was linear. To grow revenue, you had to grow headcount. That relationship is broken now. AI augmented delivery allows for higher output with a linear workforce. My base case models as 4.6% revenue CAGR against only 1.6% headcount growth, representing a 2.8 times decoupling multiples. This is not a sign of fundamental weakness, but a sign of maturity as the business pivots from a simple growth story to a non-linear delivery models. Why do I believe the business will persist into the terminal year? Approximately 76% of the enterprise value resides in terminal period, making the durability of Infosys's competitive moat the most critical pillar of this valuation. I have identified three-layer competitive moat that protects these long-term cash flows. First, switching cost remains massive. Migrating a core banking platform like Finacle is not a simple vendor swap. It carries multi-year operational risk and hundreds of millions in cost that few global banks are willing to take. Second, their intangible assets include a robust portfolio of 823 patents and domain-specific AI model within Infosys Topaz that are trained on proprietary client operational data, a data advantage that competitors simply cannot buy. Finally, they possess a first-mover advantage in AI governance with ISO 42001 certification, positioning them 2 to 3 years ahead of peers for mandatory EU AI Act compliance. Additionally, 88% of Infosys's revenue is generated in developed markets, specifically 60% from North America, 28% from Europe. By weighting the equity risk premium based on where the cash is actually earned, I arrived at a blended ERP of 5%, which in turn justifies the 10.33% weighted average cost of capital and proves the market's 11.5% implied discount rate is a sentiment-driven fear gap. To further future-proof the business, Infosys is utilizing its 37,159 crore net cash position for high conviction strategic acquisition. Deals like Intech Holding GmbH in German automotive R&D and Optimum Healthcare IT in the US move Infosys up the value chain into physical engineering and regulatory heavy healthcare transformation. These are segments where physical validation and domain complexity makes the AI work resistant, ensuring that even as AI commoditizes basic coding, Infosys' long-term terminal value remains analytically credible. This is the single most important slide for my investment thesis because it provides a quantitative proof of Infosys' structural hedge against AI disruption. To understand the AI productivity paradox, you have to look at the contract mix. Infosys earns 42% of its revenue from traditional time and materials contract. In this portion of the business, AI productivity gains do flow back to the client as cost savings because when a task takes 20% fewer hours, the client simply pays 20% less effort. This is the demand destruction the market is obsessed with. But critically, 58% of Infosys' revenue is derived from fixed price contracts. In these arrangements, Infosys is paid for a result, not an hour. A cloud migration or an AI implementation cost the same whether it takes 10,000 hours or 6,000 hours. This means that every AI-driven reduction in human effort stays inside the company as structural margin expansion. This protection is not accidental, it is deliberate and accelerating. Management has successfully shifted this mix by 600 basis points in just 2 years, from 52% in FY23 to 58% in FY25. This rapid transition, confirmed in audited financial statements, is the clearest evidence that the project Maximus is working. By moving away from billing for human time and moving toward billing for AI augmented outcomes, Infosys has created a profit engine that the market's 11.5% weighted average cost of capital completely ignores. This structural asymmetry is what allows me to model 140 bps of EBITDA margin expansion, while the rest of the market expects a collapse. To capture the financial benefits of the AI era, management is currently executing Project Maximus. This is not a standard cost-cutting exercise. It is a structural re-engineering of the firm's profitability through three specific levers. Lever 1 targets a utilization improvement from 83.5% to 85%. In my model, this adds approximately 2,800 crore to cumulative gross profit without requiring a single new hire or a single new sale. Lever 2 is the revenue headcount decoupling I discussed earlier, orchestrating a model where revenue grows nearly 3 times faster than heads. But lever 3 is the most critical, the shift towards a 62% fixed price mix by FY 2030. Lever 1 and lever 2 creates the efficiency, but lever 3 ensures that efficiency translates into 140 basis points of structural EBITDA margin expansion rather than resulting in lower client billing. Without this fixed price mix expansion, the margin story collapses. With it, Infosys becomes a profit engine that the market's fear gap fails to account for. While Maximus protects the bottom line, Infosys Topaz enables the top line. It allows Infosys to move up the value chain, commanding premium pricing in three high value categories: AI first application development, generative AI model fine tuning, and AI powered BPO. My model assumes a 3% annual realization lift, and I estimate that Topaz contributes approximately 80 to 100 basis points of that through specialized AI engagements. The primary risk is commoditization. If clients successfully demand lower price for AI work because automation has made delivery cheaper, the price premium vanishes. In that scenario, the 2% operational lift shrinks, and my bear case scenario, where revenue contracts and never recovers, becomes a baseline. This is the boundary of our risk reward, but the execution of Maximus provides a formidable defense for the long-term investor. To rigorously test the durability of this transition, I have modeled three distinct scenarios through financial year 2031. My base case projects steady revenue growth to 2,23,559 crore with an EBITDA margin of 25.1%. This assumes successful execution of Project Maximus and a controlled decoupling of revenue from labor. It is a story of structural efficiency where profitability expands by 140 bps even as top-line growth settles into a mature 4.6% CAGR. However, we must address the risk of the bear case. In this scenario, the AI productivity paradox resolves in favor of the client. Time and material compression accelerates, fixed price structures face resistance, and AI services are commoditized faster than new revenue streams can replace lost billing. This results in a revenue contraction of 0.9% CAGR. But here is the critical takeaway. Even in this scenario stress tested bear case, the downside is bounded by a fortress balance sheet carrying 37,159 crore in net cash as of financial year 2026. This provides a definitive valuation floor of approximately 1,080 rupees per share, limiting downside to just 5.8%. While the market's 11.5% implied WACC suggests an existential collapse, my analysis proves that Infosys is essentially a paid to wait. You are buying a business with 90 rupees per share in hard asset backing at a price that ignores its unrivaled financial strength. Let's look at how this translates into our DCF output now. My DCF analysis produces a base case intrinsic value of 1323 to 1358 per share. What gives me high institutional confidence in this target is the tight convergence of my two primary methodologies. The perpetuity method at 1358 and the exit multiple method at 1323 land within a narrow 35 band of each other, proving the model is internally consistent and not overly sensitive to the internal terminal value approach. This output allows us to quantify the technical heart of the opportunity, the fear gap. Working backward from the current market price of 1146, the market is discounting Infosys at implied WACC of approximately 11.3% to 11.5%. This reflects the unwarranted existential risk premium that simply isn't there in the data. My bottom-up WACC of 10.33% is not an aggressive assumption. It is a mathematical reality based on Infosys's 88% developed market revenue profile. The most critical takeaway here is that the entire 17% upside to my target price is unlocked simply through WACC normalization. This is a WACC story, not an earnings story. We don't need a single rupee of earnings surprise or margin beat to realize this value. We only need the market to eventually recognize that the AI fear it is currently pricing in is a structural miscalculation. Now let's look at how the peer group reinforces this mispricing. A relative valuation analysis provides the external confirmation of this mispricing. Currently, Infosys trades at a 9% discount to the peer EV by EBITDA median and a 12% discount to the PE median. I call this margin paradox. Infosys maintains the second highest EBITDA margin in the sector at 23.7%, trailing only industry leader TCS. In a rational market, a company with superior profitability, structural AI protection, and a robust net cash flow should trade at a premium to its peers. Instead, the market's AI fear gap has pushed Infosys to a deep discount relative to slower growing, lower margin competitors like Wipro and HCL Tech. To understand the true scale of the gap, we must normalize the peer group. The median multiples are heavily distorted by two specific outliers. Tech Mahindra's PE is inflated by turnaround restructuring cost, and HCL Tech's results are depressed by non-recurring labor code exceptional charge. The public market's error is most visible when compared to strategic transaction data. While sophisticated strategic acquirers have paid a median of 2.7 times revenue for specialist Indian IT assets, the public market is pricing Infosys at mere 2.3 times, effectively treating one of the world's most resilient IT engines as a commodity provider. Relative valuation confirms that we are buying a tier 1 leader at generic market price. Let's look at the convergence of these signals on our football field chart now. This football field chart is the technical synthesis of my entire valuation process. What should immediately be apparent is that every fundamental methodology, with the sole exception of the EV by revenue lower bound, implies significant upside to the current market price of 1146. The technical strength of my buy recommendation lies in the tight convergence of these independent signals. My base case DCF Between 1323 to 1358, the comparable company analysis EV by EBITDA median at 1205 and the strategic precedent transaction analysis median at 1263 all cluster within a narrow band of approximately 1200 to 1360. In institutional research, a single model is an estimate, but when three independent frameworks using entirely different logic and data sets all point to the same range, it becomes a definitive analytical conclusion. I want to briefly address the EV by revenue outlier. Mechanically, this methodology suggests a lower price, but this is a mathematical artifact of Infosys' superior margin profile, not a bearish signal. A high margin leader naturally commands a higher revenue multiple than lower margin peers. Therefore, applying a generic peer median to the specific metric is technically inappropriate for Tier 1 leader. By averaging the midpoints of these four methodologies, I arrive at my blended fair value of rupees 1340 per share. This convergence provides the high institutional confidence required to state that the market's current price is a sentiment-driven anomaly. It proves that 1340 is not an optimistic target, it is simply what the business is worth once the fear gap is removed from the equation. In summary, I rate Infosys a buy. The risk reward is highly skewed in favor of the long side, with a 2:1 ratio of potential upside to downside. As I have demonstrated throughout this presentation, this investment is essentially a bet on weighted average cost of capital normalization. This is not an earnings story, it is a risk premium story. The market is currently mispricing AI fear as an sixth existential structural decline, applying a punitive discount rate. However, we have seen earlier in the presentation, the project Maximus is working, and the 58% fixed price revenue mix is indeed capturing AI productivity as profit. So the 120 basis point fear gap will close eventually. To conclude, I want to leave you with the technical foundation of my model. The valuation is built on three core assumptions: a 7% risk-free rate anchored in the India 10-year-old GSEC, a 0.7% levered beta, reflecting the company's low volatility industry leadership, and a terminal growth rate of 4%. I've also modeled a strict 85% dividend payout policy, ensuring that even while waiting for the fear gap to close, investors are supported by consistent high conviction capital returns. I want to highlight a critical disclosure. 76% of my enterprise value resides in the terminal year. This is a deliberate analytical choice. It quantifies that this investment is not a bet on next quarter's earnings. It is a long duration bet on Infosys' structural resilience in the AI era. Disclaimer: this report was prepared for educational and portfolio demonstration purposes and does not constitute investment advice. Thank you for your time, and I look forward to your questions.